Asian stock markets were up on the day. This as crude oil prices picked up from historic lows recorded earlier this week, as well as sentiment being spurred by the promise of more U.S. government aid to cushion the U.S. economy. Gold prices also lifted during the session. After registering daily consecutive falls, the Japanese markets reversed some of those losses. The Nikkei share average rose by 1.5%. In Hong Kong, the Hang Seng Index rose 0.35%, while in mainland China, that was also up a little bit with the Shanghai Composite Index closing down 0.2%. Over in the United States, a significant economic stimulus package approved by the U.S. Senate brought market cheer with the promise of further stimulus. The Dow Jones Industrial Average ended the day up 2%. The S&P 500 rose 2.3%, while the tech-heavy Nasdaq firmed up by 2.8%. European markets are trading mixed today with more of a subdued inclination. However, the local equities market appears to be having a better day, with the all-share index trading up north of 1% at last check. Most counters are up, but financials are trading in the red, with the local currency more or less on the back foot. Oil prices are having a better time of it, with spot Brent crude oil currently trading around $21 a barrel. Let's take a look at the indicators. To unpack the market for us, I'm joined via Skype by Gary Boyson of Rand Swiss. Thanks very much, Gary, for joining us. How would you characterize the markets today?
So we're having a little bit of a better day today. We've got, a lot of corporate results coming out. So we've had the likes of Anglo American reporting. We've had some figures out of Goldfields as well, clicks. So some of it is company specific, but at the same time, we're also getting a recovery in overseas stock markets. That's helping to lift sentiment, as well as a recovery in the oil market after trading negative on Friday on WTI. We've seen some fairly hostile tweets out of Donald Trump. That's helped to, I suppose, escalate oil prices. And strangely, that's actually a good thing for financial markets.
So as we approach the end of the month, of course, we know that given the Moody's downgrade to junk, there's an expectation that the South African government bonds are going to come out of the World Government Bond Index. Just tell us, are we beginning to witness a situation where people are selling out of South African bonds more, or not really?
Looking at it at the moment, I mean, we've seen significant foreign outflows over the last month. So already the financial markets have been pricing it in. It's one of the reasons I think that while you have seen slightly more risk on trade over the last, say, 2 weeks from those lows that we got maybe 3 weeks after the lows we had towards the end of March, you have seen South Africa, especially from a currency point of view and a yield point of view, underperforming emerging market peers, especially commodity-based currencies and commodity-based economies. Now, that tells me that a lot of this is starting to be priced in. At the same time, there is going to be about, there's estimates from, about $2 billion worth to $8 billion worth of selling of our government bonds. Now, that actual physical selling is going to have some sort of impact on the currency. We have been fairly weak today in a risk-off environment. So, I mean, the currency, was above 1916 to the dollar at one point. We have staged a little bit of a recovery in the last few hours, back down to around 19 to the dollar. But if you look at fair value on the currency, like outside of a situation where potentially we were going to see an exit from something like the WGBI, you would expect us to be stronger. I think our fair value is sitting probably closer towards 1750, 18 than where it is currently.
And I suppose that's part of the reason why we're seeing financials bucking the trend. Most counters are up today on the local JSE, but the financials are in the red.
Our financial stocks are very South Africa dominated. I think there's a lot of uncertainty in the markets. I think you're going to get a little bit of a lighter volumes when we come to look at the exact figure at the end of the day, just because of obviously the announcement that we have tonight around lockdown. I think there's still a lot of uncertainty about how the economy is going to open up. And clearly financials are a function of how your economy is doing. As I said earlier, you've got the likes of Anglo-American reporting today. So, I mean, they're up significantly. You get Goldfields also just saying that, from an operational point of view, they're doing fairly well. The South Deep mine in South Africa might be closed. There's also the unfortunately named mine called Cerro Corona in Peru that's closed. But the majority of their operations are open. And I think what we're seeing today is you're just seeing this disconnect between, some of our international companies that are benefiting from a weaker rand, less lockdown pressure than South African Inc. companies, and obviously the South African companies, which are the banks and financials, under a little bit more pressure as the uncertainty mounts.
Yeah, I was listening to a report about the coronavirus statistics in the United States. About 4 weeks ago, they had about 400 deaths or just above that. Now they have 45,000 deaths. And of course, we closed our market or closed our economy very early into this situation. So we need to be very careful about how we open up. What's your expectation around the kind of sectors that the president may be willing to open up that perhaps can better facilitate things like social distancing?
I think at the moment, it's going to be made clear this evening in the announcement. But, I think it's going to follow the 5-phase approach that's been discussed. It's going to look at sectors that are, at the moment, I think it's going to be an expanded definition of essential services. And you're going to start seeing low impact businesses being allowed to return to work. And I think it's going to move from economy. It's going to be an intensity thing as well. We're going to, hopefully do the testing and have a look at, how different regions are impacted, and then either move them to kind of a heavier lockdown or a lighter lockdown, just to breathe a little bit of life back into the economy while still trying to maximize and preserve life.
Yeah. And what do you think about, the opinion out there? People are very opinionated, saying that the government is actually destroying the economy and that actually if they continue with a lockdown, it's going to be worse than any deaths that we might incur going forward.
You hear a lot of that sort of commentary, and I don't think it's fair. I think what the government is trying to do is maximize life, and absolutely, if you shut down the economy permanently, if the lockdown is too stringent, you run the risk of damaging incomes to the point where there are these kind of second round effects that will essentially result in greater harm. I don't think we're at that point now. I think our healthcare systems are not the same as developed healthcare systems, and an early lockdown, a strict lockdown immediately, I believe that is going to preserve life. And now it really comes down to the implementation on how we roll out the phased approach. We've given our healthcare system time to start preparing, and now as we slowly loosen up and in an attempt to find that equilibrium point, everything is still to play for. So I think it's way too early to make a call like that, and I think it's very insensitive to the massive plight of people that are going to be infected with the virus.
Yeah. Gary, thank you so much for your time and insights as always. Gary Boyson, he's a portfolio manager at Rand Swiss. Right, we're going to go for a quick